My name is Pete Von Hosel, and I'm your host for today for the webinar, How to Convert Life Insurance into a Long-Term Care Benefit Plan. And first let me say that I'm excited that you've chosen to attend this webinar. I sure hope it's going to be an event that will cause the light bulb to turn on, so to speak, that you'll catch the value of the concept that we're going to be going through. Going to go through to the appropriate disclaimers so we get those taken care of. This webinar is for financial professional licensed agent use only. It's not intended for consumer distribution. The products or plans discussed in this webinar are not available in Alaska, North Dakota, Nevada, Tennessee, Vermont, or West Virginia. The benefit amounts shown are non-binding estimates of market value presented for educational purposes only. Commission examples shown are for illustration purposes only, and you and your clients should consult with and rely on a qualified legal or tax advisor before entering into such arrangements. Our special guest speaker is Chris Orestis, and we're pleased to have him here today. He's a nationally known senior care and acknowledged expert on insurance and long-term care. He's a past vice president for the Health Insurance Association of America, or HIAA, past senior vice president for the American Council of Life Insurers. He's a contributor to the 2013 Long-Term Care Commission report. He's testified before national political bodies such as the National Conference of Insurance Legislators and numerous state regulators and legislatures such as Florida, Louisiana, New Jersey, Maine, and Texas. He's also a contributing editor to National Underwriter, Insurance News Net, Agent Sales Journal, Life Insurance Selling, Senior Market Advisor, Long-Term Care Living Magazine, On the Risk, Society of Actuaries, Health Decisions, Producers Web, ISIS, and Insure Intel. Chris, glad to have you with us today.
Pete, thanks for having me. Sorry that that's such a mouthful, all those different magazines, but it's been great to have so many different bodies paying attention to what we've been talking about.
Well, you know, I remember, Chris, when I was first made aware of the concept of converting a life insurance policy into a long-term care benefit plan. When I heard that statement, it really turned my head. I can't remember where I was reading it or what it was about. It probably was something that you had put out, but it intrigued me then, and it still does today. And I'm looking forward to our attendees coming away intrigued and informed as well. So with that, I'll just let you go ahead and take over and tell us what it's about.
Pete, thank you. Thanks, everybody, for taking some time out of your day to join us for this session. My years in Washington, D.C., and my years around the long-term care industry, we saw how many seniors had life insurance policies, and they were abandoning them after paying premiums for years. And all forms, term life, universal life, whole life, group life policies that they kept after they retired. People were dumping these policies in the last 2-3 years, 5 years or less of their life, after maybe owning them for 20 or 30 years, because they couldn't afford the premiums anymore, or they were thinking Medicaid spend down, it's time to start moving towards long-term care. Why do I still have this life insurance policy? Let's get rid of it. So we looked at that dynamic and we said there's a better way. There's a better solution for those life insurance policies. Instead of just discarding them for either a minimal amount of cash value or nothing at all by lapsing it, that is an asset that can be used to help somebody pay for long-term care. And there's no question, as I go to the next slide, Pete, that the long-term care funding crisis and the population boom is now fast upon us. Baby boomers have been turning 65, the age of 65, at the rate of 10,000 a day, going on 2-3 years now. That's every single day. 10,000 more people in this country are going on to Social Security, going on to Medicare, putting pressure on the funding safety nets that are used to cover health care costs and including Medicaid covering long-term care costs. 70% of people over the age of 65 are going to need some form of long-term care, and this is being covered in the media every day. You can't read a paper, go online, see something on TV that isn't talking one way or another about seniors, and how are people going to confront the cost of care, and what are the solutions that they have available to them? Well, one of those ways is taking a life insurance policy, converting it into a long-term care benefit plan. What does it mean? It means converting the death benefit into a living benefit, turning the death benefit, a portion of it, into a long-term care benefit plan that is set up specifically to protect the money and use it exclusively to pay for care by making monthly payments directly to the choice of care of that person. It's set up to be a no-cost option for somebody to take a look at in terms of there's no fees for filing an application, anything like that. It's a very straightforward, simple application process, and the approval process can move very quickly. The entire transaction can be done with a funded benefit account in 30 to 60 days. Every form of life insurance except for a variable policy will qualify for this conversion option. So a whole life policy, a universal life policy, a group life policy, and even term life policies, whether they're convertible or not, are eligible to be used for this kind of a way to pay for long-term care. There's no age restrictions. It's purely a matter of needing long-term care services, and the underwriting to be able to use a program like this is actually simplified underwriting. It's review of medical records, phone interview, and a pretty straightforward process to take that information and determine what the care needs are and what the costs associated would be. Once somebody would enroll in a benefit plan, they're not responsible for making premium payments any longer on the policy. It's no longer an asset in their name that will count against them for Medicaid eligibility in the future. They now have an account that is funded, set up to pay for care. Monthly payments are being made directly to their choice of care provider. The account also will preserve a final expense portion for the family, and we find that families as well as long-term care service providers are very thankful for having something left in one of these accounts at the end to help the family with those final expense needs. And an important feature of a benefit plan like this is also that it is adjustable. Somebody can start out in one form of care at one monthly price, and as their needs change, the benefit will adjust with them. For example, somebody could be in home care that they're spending $1,000 a month on, and after 6 months their needs get more acute. They have to go into an assisted living facility, and that could be $3,000 a month. With 30 days notice, you can change where the payments are being sent and how much they are to meet the evolving needs of the person who's receiving care. Any form of care qualifies, and it's important to point out, it isn't restricted to just skilled nursing or a nursing home. If somebody uses a long-term care benefit plan, they can choose home care, they can choose assisted living, they can choose memory care, they can choose any form of care that best meets their needs, and they can evolve through their care needs while they have the account. It is the legal right of policyholders throughout the country, and except for the states listed here, this is a program that is available in all states for you to be able to work with your clients. And then lastly, let me point out a very important function of this is that it is a Medicaid qualified spend down. That's very important. You don't want to direct clients towards something that would ultimately be something that could count against them for Medicaid eligibility. This actually is the definition of a Medicaid qualified spend down. Once they're done using this account and have spent through it, they could seamlessly transition over to Medicaid to take over paying for their costs of care. Now, the long-term care benefit plan is really a pretty straightforward 4-step process. 4 key steps to enroll in this kind of a program. 1, the policy owner is selling their life insurance policy for a percentage of the face value. So let's say it's a $100,000 life insurance policy. Maybe they'll get $50,000 or $60,000 for that policy, which they are then able to put into their irrevocable FDIC insured benefit account. It's a control account held by a nationally chartered bank and trust. that is in the name of the policy owner, set up specifically to pay for their care, which at their direction, they are pointing to where they want the monthly payments going. And again, all of those funds are protected, so if they were to die early and there was a balance of funds still in the account, then any balance would go to the family. And if they were to live beyond the account and switch over to Medicaid, they would still have that final expense portion sitting there to help the family after their death. Let me just run down for you the kind of enrollment criteria as agents you want to be looking out for to be able to help a family use a program like this. Let me point out first and foremost that this is a program designed to address an immediate need for long-term care. Unlike, say, a long-term care insurance policy where you would buy it for future need 10, 20, 30 years down the road, this is a way to use a life insurance policy to address care needs that are currently being provided, are imminent. People that have used this program have been in care environments where they're running out of money, and the life insurance policy is used to help them be able to continue to afford paying for care. People who have used this program would have been accessing care, but for the fact that they couldn't afford it, they use a program like this, and instead of throwing away a life insurance policy, they're able to turn it into something that's able to address their immediate need for long-term care. Again, any form of life insurance is accepted with a death benefit between $50,000 and $1 million. As I pointed out, there's no age minimums, there's no prohibitions on any carriers. All life insurance carriers will qualify. The medical underwriting process is very simple. It's a simplified process. It's a speedy process. And as licensed agents, you are eligible for compensation, which is based on the face value of the policy. Agents will need to be properly licensed and comply with the state requirements in their particular state, particularly for how their state would govern life settlements, because this is the sale of a life insurance policy to fund the benefit account. But let me point out that long-term care licensing and CE requirements are not necessary. This is not a long-term care insurance product. This is actually looked at as something that is regulated as a life insurance, on the life insurance side, as a life producer with life settlement licensing requirements as well. Let me just give you a couple of examples of recent enrollments, families that have used this program. Here you have an 86-year-old gentleman who had a $90,000 universal life policy. There was no cash value left in this policy, and in fact was about ready to let the policy go and let it lapse. The assisted living community that he wanted to move into let him know that this was an option he might want to consider before letting go of the policy. He took a look at it, and based on the underwriting, was able to get from this $90,000 policy $31,500 put into the benefit account that was then set up to meet his needs, which he was coming up short about half the amount that they needed on a monthly basis to pay for him to go into the assisted living community. So in addition to the about $2,000 a month they had available, they added $1,800 a month that they drew down off of this account so that he could afford to move into the assisted living community where he lived for the next couple of years. A second example was a 70-year-old gentleman with a $250,000 non-convertible term life policy. This was a policy that they were about to lapse and let go. They couldn't afford the premium payments until they found out that this was an option for them, which they decided to pursue. And based on his condition, he was able to get $150,000 out of the $250,000 term life policy, converted into a $150,000 benefit plan, which was set up so that he could remain at home. The family's goal was to keep him at home. So to the tune of $10,000 a month that they drew off of this account, he was able to get 24-hour skilled nursing care for the remainder of his life. Now in this circumstance, this gentleman actually passed away before he used up the entire account. So there was about $75,000, $80,000 left in the account when he died, which then went immediately to the family. So this family took a $250,000 non-convertible term life policy they were about to throw away and instead turned it into a way to keep their father at home, getting 24-hour nursing care, and they were able to receive more money at the end that hadn't been used up in the account from a policy that they were going to throw away and get nothing back in return. In terms of the structure, the long-term care benefit plan structure, again, the policy ownership is transferred to fund the benefit account. The benefit account is held as an irrevocable account in the family's name at a nationally chartered bank and trust company so that the money is in total, full, locked up in that account, protected. The money can't be used for anything other than long-term care, so the family couldn't just take the money and go on a world cruise or throw it around and blow it and do what they want. It is there and held to protect that money to make sure that the monthly payments are being made direct to the care provider, which families and care providers both appreciate, knowing that that money's there and that every month those payments are going to be made directly to the care provider. In terms of regulatory structure, this program adheres to 3 levels of regulation. 1, the policy transfer is compliant with life settlement regulations in every state. The benefit account adheres to banking regulations at a federal level. And the use of funds, because they're being used to pay exclusively for long-term care, are Medicaid qualified as a spend down. And again, we point out this is the legal right of a policy owner across the United States in every state, except these states where this program could not be made available. I do want to point out, and some of you may have heard or read about in the news over the course of the last year, there has been legislative activity and political support across the country for this program. Now, again, anybody can do this program today. There's no need for legislation or anything, law to be passed for somebody to use this program today. People are using it across the country. They're accessing it through nursing homes. They're accessing it now through agents and advisors. But these states, Texas, California, Florida, New York, New Jersey, 10 states here, in 2013, took the initiative to say, wait a minute, we have seniors in our state with life insurance policy, millions of dollars that they're dumping and trying to jump onto Medicaid. What we need is to empower our Medicaid departments to inform consumers that this is a legal right they have, that they can do something else with their policy, a better use for their policy. Turn it into a private pay account like this long-term care benefit account. Choose the form of care they want, stay private pay as long as possible, delay their need to go on to Medicaid. It's better for the consumer, it's better for the taxpayer of the state. It's saving states money, it's saving taxpayer dollars. So these states have introduced legislation where their Medicaid departments now will be able to inform the consumer that this is something they can do, and Texas was the first state in the country to actually pass this into law, which now is on the books. And this awareness that states want to create so that their citizens know this is something they can do is growing every day. Speaking of growing every day, here's just a sample of some of the long-term care companies that are out there that offer and accept this kind of a funding option. These are some of the biggest nursing home and assisted living and home care companies in the United States. They all accept and actually encourage families to use this kind of an approach as a way to help them pay for care. And many of these companies collaborate with insurance agents and advisors across the country to help seniors access this option. There's been growing awareness in the media, stories in the New York Times, the Wall Street Journal, radio stories. It's been really amazing to see over the last couple of years, and particularly in 2013, how much more awareness, how much more media awareness and attention, what's going on online. If you Google long-term care benefit plan, that kind of stuff, you'll see a lot of information, a lot of adoption of this, a lot of an awakening across the country that this is a way that people can use a life insurance policy to pay for care, and now we're seeing agents who are waking up to realizing, hey, this is another tool we can put in our toolbox. This is another way we can work with families to help them pay for care, a way to address immediate need, a way to make sure that they're not throwing away a life insurance policy that they might get a better use out of. So in conclusion, I'm just going to say this is really a good opportunity and still somewhat of a ground floor opportunity for agents and advisors. It's really only been recently that agents and advisors have embraced and started to roll out with a program like this and to add it to what they're offering their clients. It's a great opportunity for us to be on this webinar and speak with you today. Look forward to any questions that you may have as we come to the conclusion of the presentation. And Pete, I'll just pass it back over to you.
All righty, Chris, I really appreciate it. We're going to be, fielding some questions here in just a few minutes. I wanted to go over a couple of items, and that would be looking at the possible prospects and the compensation that would be available to you. And let's get into that right now. So who are your prospects? They're going to be folks who are currently receiving or are about to receive long-term care within 90 days of receiving it, and have a life insurance policy. Obviously, $50,000 to $1 million is the parameters for this conversion to a long-term care benefit plan. You've also got the adult children of parents, relatives who are currently receiving or about to receive long-term care and have that life insurance policy within those parameters. So don't necessarily look just to the individuals who are receiving or about to receive long-term care. Their children are looking for solutions as well. Now, if you don't have someone who's a candidate for a life to long-term care benefit plan conversion, but you think you may have someone who wants to sell their policy for cash via our life settlement services, you want to make sure to bring those cases to us and let us know. The criteria there for a typical traditional life settlement is going to be insureds age 65 and up, convertible term or universal life, face amount $50,000 and up. There's no upper end limit. The insured has to have had a significant change in health since the policy issue. That's one of the key areas. But when in doubt, what you want to make sure is give us a call and let us run the case, through some, filtering and see if we've got a case on our hands. Now, what are the compensation possibilities for you? For the life insurance conversion to long-term care benefit plan that we've been talking about, you've got the commission on the sale of the existing policy. And that's going to be whether it's a term plan, term conversion to UL, whole life plan, as Chris mentioned, a group plan, doesn't have to be convertible term. You're going to have 3% coming to you calculated on the face amount. Let me give you an example of that. You have a $250,000 policy. That could mean $7,500 to you just on that sale of the policy. You've also got the possible commission on the conversion to UL of a term policy. Now, your compensation levels are going to vary depending on the company, the product, that type of thing. But for example, if you've got a $250,000 term conversion, and let's assume a first-year premium of $10,000, and you're on an 80% first-year compensation level, that could mean $8,000 of commissionable premium to you, and that's on top of the life settlement or the conversion to long-term care compensation that we went over earlier. Now, on the traditional life settlement channel, you've got a commission on the sale of the existing policy. That's going to be based a little bit differently than the previous program we're talking about. Lesser of 3% of the face or 15% of the gross offer. Again, whichever is going to be the smaller amount. That's how we calculate it. Then you've also, again, got the commission on the conversion to UL if you've got a term policy. Let me give you a couple of traditional life settlement examples, and these are real-life examples that we have brokered and taken care of. One was a male, age 74, had a 7 to 8 year life expectancy, had a convertible term for $1 million. The life settlement cash paid to that insured was $80,000. The life settlement commission paid to the broker was $5,000. And then get this, the term conversion commission paid to the broker to convert that to a universal life was $66,000. So the total to the broker on that transaction involving both the sale and the conversion, $71,000 in compensation. So you can be bringing some very valuable concepts to your clients and being rewarded very handsomely for it. Here's another example. You've got a female age 69, 4 to 5 year life expectancy, convertible term, a lot less than the previous example, $150,000, but look at this. You've got a life settlement cash amount paid to the insured, $60,000. She was thrilled because she was going to let it go. The life settlement commission paid to the broker was $9,000, and the term conversion commission that went to the broker when we converted it was $3,400. So smaller case than the previous one, to be sure, but still total of $12,400 to the broker. If you have a case that you think you might want to run by us, you want to get more information, you want to contact us, Tim Mena is your CIGI brokerage wholesaler. His number 800-876-8484 and his extension 7156. The email address tim.mena@cigilife.com. And Tim can typically tell you quickly if your case is worth pursuing. You want to remember that for us, CIGI, we want to be your go-to agency for the products that you see listed there, whether it be term, universal life, index universal life, whole life, final expense life, annuities, life settlements like we're talking about today, long-term care, accident medical insurance. We've got the guaranteed highest commissions and a great, friendly, helpful staff, so you want to get in touch with us and see if we can provide you with services in all of those areas. I want to thank Chris so much for being with us. Thanks for taking time out of your day and explaining this very dynamic and I think what's going to be a growing concept for agents to be able to present to clients. And so thanks for being with us, Chris. I want to thank everybody on the line for joining us. And again, you're going to be notified when a recording is available of the webinar. To get in contact with us again, 800-876-8484, and our email address, brokerinfo@cigilife.com, and then you have our website, www.cigilife.com. So that will end our webinar for today. I appreciate everybody being with us, and take care. We look to talk with you soon.